Greetings and salutations. Today we're going to look at the company Bank of Montreal, headquartered in Canada, and traded on Toronto Stock Exchange and New York Stock Exchange under the ticker BMO. Please stay tuned for the important disclosure information at the conclusion of this video. The Bank of Montreal, or BMO, is the third or fourth largest Canadian bank. The bank is one of Canada's Big Five banks, which together control more than 90% of the market and operate across the country. BMO was founded in 1817 and incorporated the same year, making it Canada's first publicly traded bank. BMO paid dividends every year since 1829, meaning it had already been paying dividends for 38 years by the time Canada was officially formed as a country in 1867. Bank draws revenues almost equally from Canada and the United States. Given the nature of the business, the currency used in 40F reports, and relative stability of the Canadian dollar to the United States dollar, this analysis is produced in Canadian dollars. All numbers you will see in this report are Canadian dollars unless specified otherwise. The intrinsic value analysis of banks is very different due to the nature of business and accounting records. Banks obtain equity by issuing shares or retaining earnings. They also attract deposits and issue debt, for which banks pay interest. Funds from equity, deposits, and debt are being used to generate revenue. The ratio of deposits and debt to equity is of paramount importance, as it increases the leverage of the bank, thus allowing greater revenues and simultaneously producing greater risks. The bank must set aside a portion of funds in the form of liquid assets, for which it will be able to collect interest. The rest of the capital bank issues as loans that also yield interest, but sometimes fail and result in credit loss in the form of net write-offs. On top of that, banks are engaged in daily operations that yield non-interest income. All of the above result in the non-interest operational expense. Net income is mostly spent on dividends and equity growth, as well as on repurchasing shares, acquiring existing businesses, and other. Please note the numeric notation, as you will see it in the slide titles for the ease of navigation. Real equity growth, net of shares dilution, between 2005 and 2023 stands at 6.4% per year, while inflation is estimated at 2.3% per annum. Total nominal equity growth, including shares issue, shows 10.1% compound annual growth rate. Based on the available equity, banks attract deposits from households, businesses, and governments. Deposits to equity ratio plays a crucial role in determining most of the bank's leverage. BMO had this ratio at about 14 in the late 2000s, slowly reducing to 11.2 by 2019, and by 2023 returning to 11.7, closer to a long-time average of 12.5. Along with deposits, to leverage up, banks issue debt. Debt is more flexible to quickly issue and redeem. The combination of deposits and debt to equity ratio ultimately determines the leverage of the bank. We saw the highest in 2008 at 20 and the lowest in 2017 at 14. In 2023 it was at 14.5, still below the long-term average of 16. Debt is only about a quarter of attracted deposits and serves as a counterbalance to have a more stable leverage ratio. Equity, deposits, and debt altogether serve as total capital the bank can work with. Attracting deposits and debt entails risks. A portion of this capital must be set aside for liquidity and financial stability of the bank. The ratio of liquidity assets to the combination of debt and deposits averaged around 0.45 to 0.52. The 2023 value equals the long-term average of 0.49. Most of the remaining available capital is issued in the form of loans to households, businesses, and governments. Loans are the major source of revenue for banks. We can see capital allocated for loans to be stagnating till 2010. However, since then a more aggressive growth was shown. Finally, let's look at net income and capital allocation. Net income shows highly uneven growth with periods of stagnation, reversion, and rapid acceleration. Between 2005 and 2021, nominal net income showed 7.6% compound annual growth rate. In 2022 it jumped 73% up, and in 2023 tumbled 67% down to the levels last seen in 2015. We will investigate this roller coaster. Additionally, we will need to investigate the same period between 2022 and 2023 of rapid shares dilution, why the bank issued more shares, and how the capital was allocated. All of net earnings since 2005 was allocated between dividends, about 40%, and equity growth, 60%. Let's start with the drop in net income in 2023. As we can see, the revenue of the bank consists of income from loans, 50%, income from liquid assets, 32%, and non-interest operating income, the remaining 18%. Bank expenses 42% is deposit interest payments, 16% is debt interest, 33% is non-interest operational expenses, 4% is tax, and 3% is provision for credit losses. Income from loans contributes 50% to the total revenue. All loans are directly tied to the central bank interest rate, with a few percentage points on top of it. If the central bank interest rates change, it takes time for the asset performance to gradually adjust to the new rates as customers renew their loans. As for the loan mix, business and government loans are about half of all loans issued. Historically, they charge an additional 3.3% on top of central bank interest rate. Residential mortgages, 30% of the loans mix, show 2.5% extra to CB interest rate. Personal loans and credit cards are 20% of the remaining loan mix and charging an additional 3.5% interest on top of the CB rate. The total mix of all assets is expected to produce an interest rate equal to the central bank rate plus 3.1%. Issuing loans is directly connected to the risks of loan defaults. Historically, we saw about 3% of the total expenses of the bank spent on loan defaults. That is about 7% of the revenue from the loans themselves. In 2023, this number is just 6.4%, not much higher than in previous years. More specifically, residential mortgage defaults account for about 1.2% of the income between 2005 and 2023, with spikes in 2010 and 2020 to 2.4 and 2.2% respectively. Personal loans and credit cards expect to lose 15.7% of the income they generate, with a historical spike in 2009 at 31%. Business and government loan interest income was diminished by 6.3% for defaults, with a 28% spike during 2008 and 23% during the pandemic of 2020. The stability buffer, in the form of liquid assets, delivered about 32% of total bank's revenue. These liquid assets consist of trading and investing securities, about 50 to 70% of the buffer. Resale agreements, or repos, about 25%. And the remaining in the form of deposits with other financial institutions. Resale agreements are a form of short-term borrowing by other banks. The performance of liquidity assets is almost entirely dictated by central bank interest rates with a lag, with a noticeable exception of trading and investing securities showing a significant return above interest rates, especially during the economic downturns, as in 2008 and 2020. The deposits the bank attracts come primarily from three sources. The interest paid on them also heavily depends on the central bank interest rate with a lag. Business and government deposits account for half to two-thirds of all deposits. The bank pays CB interest rate plus 0.1%. Personal deposits are an additional third of deposits. Deposits from other financial institutions, mostly banks, account for the remaining 5 to 15% of the mix. The interest for the last two closely matches the CB rate. Overall, based on the mix, we can expect the interest paid to be aligned with the CB rate. The debt the bank attracts for operations contributes only 16% of the total expenses. The interest paid for it can be expected at the level of central bank interest rate plus additional 0.9% with a lag. One of the most interesting discussions of this analysis is the model of the interest rate adjustment lag. Since 2005, we have had several periods of hiking and lowering central bank interest rates. Bank loans, liquid assets, deposits, and debts adjusted to the new rates with a lag. It is logical, since for example, Canadian residential mortgages are often issued with a fixed interest rate for several years and have to be renewed after. Another example is the deposit interest offered by the bank, as the competition between banks can prevent lowering it immediately after the CB rates drop. We built a regression model to predict the change in real banks' interest rates on assets and liabilities after the change in the CB interest rate. Based on different combinations of inputs, we tested several regression models to minimize the prediction error subject to bias variance trade-off. Please note, since we have only a few data samples, we can't be highly confident in the accuracy of the model. We built separate regression models for assets and liabilities interest rates. The models chosen for this analysis were linear regressions based on 4 inputs: expected interest rate, partially based on CB rate change this year, last year, and 2 years ago. Please see them on the slide. Stay tuned, as we will discuss the expected interest net income in the upcoming slides. For now, let's evaluate operating non-interest income. Non-interest income comes mostly, about 38%, from banking services, which are subscription payments, paid transfers, and overdraft protection fees. Other additional major categories include insurance, wealth management services, and banks' mutual funds management expense ratio charges. The historic growth rate of total non-interest income since 2013 was about 5.6% compound annual growth rate. Yearly inflation during those years was about 2.3%, making the real growth of about 3.2% per year. Moreover, the growth was not even, with periods of stagnation. You might notice that 2023 results of $12.4 billion are almost the same as the number in 2017, 6 years ago. Based on the growth by category since 2013 and since 2018, we estimate that non-interest income can grow at a 3.3% nominal rate or 1% real rate, assuming the inflation returns to the historical trend. Operational expenses and taxes, as a proportion of interest and non-interest net income combined, were stably hovering around 64 to 77%, with an average of 71 and a current value of 77%. About half of these expenses are salaries. Premises and taxes form another third. Now, we can put together this jigsaw puzzle of a drop in net income in 2023. As we discussed before, operational expenses and revenues, taxes, and provision for credit losses all appear to be within historic norms, albeit the provision for credit losses increased by about $2 billion. The major reason for lower net income in 2023 is the lag in adjusting interest income to new central bank interest rates. Using historic interest rates for the current mix of assets and liabilities, we can expect net income to be higher, at around $8.8 billion, double the reported. Obviously, because of the lag, we will see higher interest-based income in the upcoming years, even if the central bank drops the rate in the future. In the second investigation, we will examine the period of rapid share issue between 2022 and 2023 and an abnormally high net income of 2022. In 2022 and 2023, BMO issued shares for $7.8 billion, however the equity has increased by $18 billion. During these years, the bank spent at least $21 billion on the acquisition of Bank of the West. Due to accounting regulations, this acquisition increased the reported net income by $7.7 billion in 2022, meaning the organic net income was $5.8 billion during that year. Finally, we can look at the big picture of the intrinsic value of the Bank of Montreal. It is the third or fourth largest bank in Canada, with half of its revenue generated locally. It operates in all provinces of Canada, and some people might consider it too big to fail. About 44% of the revenue of the bank is diversified away from Canada into the United States. Historical growth of the real, inflation-adjusted, net income of the bank between 2007 and 2022 is about 4.9% per annum. If we consider the reported real, inflation-adjusted, net income from 2007 to 2023, the growth is just 2.5%. However, the model expected rate is much higher at 7.3%. Net income growth appears to be highly uneven throughout the years. Also, we see a lag in net income. Once the lag income catches up, models suggest we can theoretically see a net income of about $8.8 billion, much higher than the 2023 $4.4 billion reported. The bank was overall very successful at allocating about 40% of the accumulated net earnings into dividends and the rest into equity growth. Overall, the bank is well balanced on all ratios we discussed in this analysis, with some potential room for minor expansion in deposits and debts. The intrinsic value model for banks has to be associated with dividends. In 2024, banks' dividends are projected to be $4.6 billion, or $6.36 per share. If we apply a 5.5% discount rate, the intrinsic value with 0% real dividend growth indefinitely yields $115.60 per share, an implied PB ratio of 0.98. Growth of 2% yields $181.70 per share, an implied 1.53 price-to-book ratio. And a growth of 4% yields $424 per share, an implied 3.58 PB ratio. The historic real, inflation-adjusted, dividend growth till 2024 was 4.3% since 2005 and 7% since 1989. The big question is the potential damage to the banks by a possible recession in Canada, especially in real estate. For this, we will use the paper, published in 2022, by the Central Bank of Canada. In this publication, authors modeled a severe recession and its impact on banking assets. In a hypothetical scenario, Canada sees a contraction of real GDP by 5.8%, unemployment peak at 13.5%, and housing prices decline by 29%. In this event, authors suggest the bank loss of 34.8% of its credit card loans, 9.2% of other consumer credit, 0.7% of uninsured mortgages, 6.3% of business loans, and 8.2% of non-residential mortgages over a period of 3 years before stabilization and recovery. For BMO, that equates to approximately $38 to $43 billion. That is roughly 8 to 9 years' worth of dividend payments, or about $59 worth of value per share. Please note that Scotiabank is Basel III compliant, which is one of the strictest regulations for bank sustainability. Therefore, we assume that the bank will be able to withstand this severe recession and even continue dividend payments, albeit at a lower rate or at the expense of the future equity growth. International investors should also be mindful about the United States to Canadian dollar historical exchange rate, as, in the past 50 years, it has bounced between 1 and 1.4, with the current readings of 1.44. Thus, if the exchange rate mean reverts, we can expect to add an extra 20 to 30% of the intrinsic value in the United States dollars. Canadian investors should be mindful of favorable eligible dividend taxation for the tax residents of Canada. The exact calculations are complex, and we will not discuss them in detail. However, we are going to provide 3 examples of individuals making $43,000, $80,000, and $120,000 per year through employment income and their eligible dividend tax advantage. In these examples, the intrinsic value can be augmented by about 10 to 15% for Canadian tax residents. Please note, this is not tax advice, and this channel insists on consulting with your lawyer about anything discussed in this video. Finally, let's look at the numbers. In the scenario of 0% real growth of dividends indefinitely and a severe recession that starts on year 1, the intrinsic value of one share is estimated at $57. Without the severe recession, this number is $116. The implied price-to-book ratio is 0.48 and 0.98 respectively. A gentle reminder, everything discussed in this video was in Canadian dollars. With a real dividend growth of 2.3%, without a major recession, the intrinsic value of the bank is estimated at $199 per share, an implied PB of 1.68. On top of these numbers, we can potentially add 20 to 30% for the mean reversion of the Canadian to American dollar exchange rate. and an extra 10 to 15% for favorable taxation of eligible dividends for Canadian residents. Have we ever seen a PB ratio of 1.68 in the past? Yes. In the table below you can find the PB ratios of all 5 plus 1 major banks of Canada and their PB ratios by year since 2002. BMO saw a PB ratio of 2.4 in 2005 and is currently being traded at 1.2. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.